John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hi, my name is John Ulzheimer, and I am a consumer credit expert, formerly of FICO and formerly of Equifax. FICO, of course, is the company that invented the ubiquitous FICO credit scoring system, which has been commercially available in the U.S. since 1989, and also Equifax, which is one of the three generally recognized credit reporting agencies. Equifax, in one form or another, has been around since the late 1800s, and so they're a really old credit reporting agency. So today's question comes from the Tradeline Supply YouTube channel. Good stuff on the YouTube channel. If you want to ask questions, please drop some questions in the comment section. It gives me some really good ideas, and I know what you're wanting me to talk about. So rather than me telling you what I want to talk about, I love to see what you're interested in hearing about, and I'm happy to answer the questions. And so one of the questions that pops up from time to time is, it's actually based on a myth, and so we're doing a little bit of myth busting today. The question is about how credit scoring systems consider revolving accounts. And I'm actually going to expand on this a little bit, because revolving includes plastic, so in other words, credit cards, general use credit cards like Visas and MasterCards. Revolving also includes petroleum cards, so like your Texaco card, your Chevron card, your gas station cards. And it also includes your kind of garden variety retail store cards, so like your Home Depot card, your Lowe's card, your Macy's card, your whatever, Gap card. Those are all retail store credit cards. They're all plastic, they're all credit cards, they're all revolving, meaning that you have revolving terms, which means that you can carry a balance from month to month to month and pay interest as you do. Or you can pay it in full every single month and you pay no interest. When you use your card, you have a credit limit, which is your uppermost boundary of your credit, your buying power, if you will. You can spend into your credit limit and you can pay it down, and you can spend into it again. You can do it over and over and over again. So you have this available amount, and as long as you're not using 100% of it, you always have some amount of buying power, or what's called open to buy. HELOCs, home equity lines of credit, which are not mortgages, and they're also not loans, are also lines of credit that have revolving terms. However, you don't get assigned a credit card, meaning that the line of credit is resident with your bank, and you can tap into that line of credit, use it for whatever you want to use it for. You can use it to, add a deck to the back of your house. You can use it to pay off an auto loan. You can use it to pay off credit card debt. You can use it to go on vacation. Not a great idea, but you can if you want to. You can go gambling with it. Again, not a great idea, but it's your money. You can do whatever you want with it. And when you pay down the debt, then you get access to that line again, and you can just kind of reuse it. So it sounds very similar to a credit card. And then you have charge cards. So charge cards are going to be like your American Express green card, where you can use it. It's plastic, but you have to pay it in full every single month. So it has what's referred to as open terms. Open does not mean the opposite of closed in this context. Open means that payment in full is due every single time you get a statement. So those are three types of accounts that have some similarities, not only in the structure of the actual physical representation of the credit, but also with the terms. So one of the complicated or confusing issues is, how are these treated by credit scoring systems? Are they all treated the same? Are they treated slightly differently? Credit card accounts are treated like revolving accounts, and they are considered in the infamous revolving utilization or balance to limit ratio. And the higher that ratio goes, the fewer points you earn for that metric. And so you want that ratio to be as low as possible. And that's based on just a simple math problem. You divide your balances by your credit limits, and that equals your revolving utilization ratio. A lot of people believe incorrectly that HELOCs are also considered in that metric. They are not. HELOCs are clearly identified on your credit report as home equity line of credit, not a credit card. And so there is no possibility that a credit scoring system can confuse a HELOC with a credit card. So just because you go out and max out your HELOC because you want to build a nice addition to your house, it doesn't mean that your revolving utilization ratio, as it's calculated by credit scoring systems, are going to misinterpret the HELOC as being a credit card and cause a large spike in the ratio and therefore a lower score. Charge cards, it's a little bit different. And charge cards, it's going to be one of these it depends. answers. In the more contemporary credit scoring systems, the newer versions of FICO and VantageScore and such, charge cards are treated like charge cards, meaning that they understand that you have to make a payment in full every month and you don't have revolving terms. They are not considered like credit cards in these newer scoring systems. And some of the older credit scoring systems, some of them that are still commercially in use today, do consider charge cards as part of the revolving utilization ratio. So just keep that in mind. So the answer is going to be, in some of the scoring systems, yes, and some of the scoring systems, no. But the goal is to not treat anything that's not a pure credit card as a credit card. So in other words, HELOCs and charge cards, which are not credit cards, are never considered as credit cards, except for the exception is charge cards, but only in some of the older credit scoring systems, never HELOCs. So you're going to see a lot of incorrect information on the internet about that issue of HELOCs, but it's incorrect. This has been verified by FICO. The intention was never to consider HELOCs the same way that credit cards are considered. So take it to the bank. HELOCs are considered separately. They're not considered mortgages because they're not mortgages. A mortgage is an installment loan, meaning that you have a fixed payment for a fixed number of months. And so a very common type of mortgage is the 30-year fixed rate mortgage. And so you have 360 equal payments of some amount of money, and then after you make all those payments, then the loan is paid off and then you're going to own your house. That's not a HELOC. You don't have the same payment every single month for a certain number of months. Your payment can vary because your balance can vary from month to month depending on how much of the line you have tapped versus how much of the line you have paid off. So it's definitely not a mortgage, even though it's kind of mortgage-like. So thank you for the question. Very good question. Helps dispel a pretty common myth about how HELOCs are treated. And if you've got any other questions, leave them in the comment section below and I'll do my best to get to them. Thank you again for watching and have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.